Leader of opposition in the Lok Sabha, Rahul Gandhi has voiced concerns over India's economic slowdown, citing the GDP growth rate hitting a two-year low of 5.4% in second quarter of FY25. He emphasized the growing income disparity and its impact on the middle class, farmers, laborers, and the poor. He said that the Indian economy cannot progress if its benefits are limited to a few billionaires. Gandhi pointed to inflation and a depreciating rupee as signs of economic distress. Laying down the facts from the recently published GDP growth data, he mentioned that retail inflation surged to 6.21% in October, which is a 14-month high, while prices of essential commodities like potatoes and onions increased by nearly 50%. The Indian rupee hit an all-time high of 84.50 against the US dollar. He also highlighted record unemployment levels and stagnating or declining incomes for workers, employees, and small businesses over the past 5 years. Rahul Gandhi noted reduced incomes have led to lower consumer demand. He said in the tweet that the share of cars priced below 10 lakh rupees has dropped from 80% in 2018-19 to less than 50% now, while affordable housing sales have fallen to 22% of the total sales, down from 38% last year, while fast-moving consumer goods or FMCG demand has been on a decline. Gandhi further claimed that structural changes like demonetization and GST had contributed to the manufacturing sector's decline to 13% of GDP, which is the lowest in 50 years. Arguing for a fresh economic approach, Gandhi stated a new deal for businesses is essential. Equal opportunity for all is the only way to get the economy moving forward. Amid the economic slowdown, economists have also revised GDP growth forecast for FY25. MK Research has cut its growth forecast to 6% from 6.5%, while CRISIL has lowered its estimate to 6.8%, down from 8.2% growth in FY24. HDFC Bank, on the other hand, revised its projections to 6.5% from 6.8%, citing downside risks. The nominal GDP growth for the first half of FY25 was 8.9%. To meet the government's assumed growth rate of 10.5% in the budget, the economy must expand by over 12% in the second half of FY25, which is a daunting task amid existing headwinds. Economists identified a slowdown in urban demand and reduced government capital expenditure as major growth inhibitors. Urban wage growth has been slowing since second half of FY24, impacting consumption demand. Companies face reduced profit growth, which affects private corporate capex. Electronic payments data indicates only a moderate pickup during the festive season. Some experts remained cautiously optimistic about the second half of FY25. Chanvi Prabhakar from Bank of Baroda expects growth of 6.6% to 6.8%, supported by increased government spending, investment revival, and strong consumption demand. While Madhavi Arora from MK Global Financial Services projects a 6% growth but warns of persistent headwinds like lower private consumption and declining real urban wages. While economic headwinds persist, economists emphasize the need for a robust policy framework and recovery measures to support sustainable growth. The focus remains on addressing inflation, reviving consumption, and creating equitable opportunities to drive economic progress.